What is going on, investors? Hopefully you guys are having a great day out there. Time to kick off FANG earnings season with Netflix Incorporated, ticker symbol NFLX. They just reported their earnings just moments ago, and we will get into them. We'll take a look at the revenue, the profit, the guidance as well, and the all-important subscriber growth, or in this case, subscriber subtraction, believe it or not. So we'll talk about that here as well. We'll go over the numbers. We'll take a look at some pie charts and things like that. Some of this stuff I just found interesting. We'll take a look at the regional growth in terms of subscribers, revenue, those types of things. And then we'll get into the financials as well, where we take a look at revenues, profit from kind of a higher level view as well. And then we'll get over to the stock chart on this one. This one had a big negative reaction. Okay, you see right here, this candle, this was a big old negative reaction to these earnings. Now it has walked itself kind of back up a little bit as we do this video. I would expect this to bounce around, but at the current time, we're down about 3% on Netflix. During the regular trade, the thing was basically flat, up about $2, 0.37%. Over the last year, we're up about 8% on this one. Got a nice little $235 billion market cap. It's actually the one FANG stock that I don't own, and we'll talk about why maybe here and give you some reasons on that as we get into today's video. Now, speaking of today's video, we're going to highlight Q2 earnings, which, like I said, came out just moments ago. Their EPS missed by 19 cents, but they did beat on revenue. We'll talk about why they beat on revenue, but their earnings per share kind of missed a little bit. Now, here's their guidance, which was kind of interesting. Revenue coming in at $7.48 billion. This is for Q3, the upcoming quarter. That is meeting consensus. EPS was coming in at $2.55. That is ahead of consensus, but as we talked about, the share price of this stock is reacting very negatively to this news because what people care about is global streaming paid membership. They anticipate it coming in at 212.68 million. People were expecting 214.8. So that's a good about 2 million subscribers less than what they think. And global streaming paid net additions coming in at 3.5 million. This is for Q3. The street was expecting almost 6 million. So you can see why shares, at least initially, reacted very negatively. But I think investors are starting to digest these numbers. Now, one thing we constantly talk about on our Friday show, where we recap all the FANG stocks, including Netflix and all the other ones, is we talked about what's next for Netflix. You kind of have to say that very carefully. So we've gotten a little bit of a window that they're going to jump into this video game on today's conference call over the next couple of days. I would expect some more color on the video game chatter with Netflix. What are they going to do? Are they just going to allow publishers to kind of port into their platform? Are they going to create their own games? Are they going to buy a development studio? Those types of things. We'll see what Netflix decides to do, but it can be, and it could be potentially a game changer for Netflix, because as we jump into the numbers here, we're going to take a look at it from a high level, and then we'll kind of narrow it down to different regions, and then we'll jump back into the revenue and profit in a little bit more detail here in a second. But from a high level, you've got here revenue coming in at $7.34 billion. Next quarter, they're anticipating very close to about $7.5 billion worth of revenue. On a year-over-year growth perspective, in the most recent quarter, they grew at 19%. You see, though, in the previous quarters, we were growing in that low 20s to mid 20s, and now we've slipped to 19, and we're slipping to about 16% growth. When you look at the other FANG stocks like Facebook and Google and even Apple, like the old guard tech like Microsoft, they're growing at a faster clip than this. So Netflix is starting to slip behind in terms of growth. They are going to have to do something to kind of turbocharge this at some point. Now, operating income, again, very nice, coming in at 1.8, call that $1.9 billion. That's about or as high or higher than where we've been over the last year. They're coming in at 1.5 billion in the upcoming quarter as well. Operating margins in that low to mid 20s. Again, I don't think investors really care about this. What do they care about are these global streaming paid memberships. Notice we ticked up to 209 million in the quarter, but we're only ticking up to 212 million on the Q3 forecast. Look, we were growing, and this time last year, everybody was staying at home. Everybody was binge watching stuff, those types of things. We were growing in those mid to high 20%, and it started slipping off in Q4, really fell off a cliff in Q1, but it has continued to decelerate. Okay, we were growing at 13.6% last quarter. This quarter, global paid memberships grew at only 8.4%, and next quarter, it is expected to grow in that range as well. So now we're only growing like in that 8%, 9% range. So that is not necessarily good. And I think investors are starting to digest that. The other thing you want to think about is not only is Netflix competing with Hulu and YouTube and Disney and Amazon and traditional cable and other types of entertainment out there, they're competing for shareholder dollars as well. So that's what I want you to think about too. Okay, so Netflix looks like this is share of total US TV time. You got other streaming coming in at 8%. Netflix comes in at 7%. YouTube comes in at 6%. Hulu, which I think is part owned by Disney, down here at 2%. Amazon coming in at 2%. Here's what I want you to think about. Yes, you get 7% of the market if you invest directly into Netflix, but that's about all you get, because that is Netflix's business. Netflix's business is streaming. Do they make some money some other ways? Maybe a little bit, but not much. Think about YouTube. That is just one sliver of a bigger company called Google. And so Google, you get online advertising, you get Android, you get mobile, and you get almost the same exposure to streaming share. And then when we're talking about Disney, we're talking about Hulu and Disney Plus. Now we're talking about a combined 5% of the market, and you get access to parks, content library. Obviously, Disney Plus is growing tremendously as well. And if you want to throw in Amazon as well, you get e-commerce, AWS, online advertising, lots of different things by investing in Amazon. So while Netflix is the global share of TV time, they are outpacing Google, Disney, and Amazon. They are a completely one-dimensional business. And so in my opinion, doesn't necessarily make it as an attractive business as these other ones that are knocking right on Netflix's heels and have other business models which are extremely attractive to invest in as well. Now, let's take a look at some stuff here. When it comes to Netflix, we've got UCAN, which is United States and Canada. We see revenues coming in nice, okay? Came in at $3.2 billion. Paid membership, though, look, we actually declined in our biggest market here in the United States. Look, we went from 74.38 million subscribers down to 73.95. We actually declined. We almost wiped out all the ads that we had last quarter. And so we've basically been flat for the last 6 months over at Netflix in the United States and Canada. And we've talked about this numerous times when we do Netflix's videos and when we talk about them on our Fang Stock Recap show. Netflix has peaked here in United States and North America. Okay, so I would not expect this number to accelerate any meaningful direction because we saw the whole acceleration here in Q2 and we've basically been flat, if not down, over since then. And I would not expect that to turn around. Now, how are they squeezing out more revenue? Well, they're raising the price. Look, the average user was $14.25 last quarter. Now it's $14.54. That is good for 10% year over year. So that is how they're going to squeeze more out of the same subscribers here in the United States. They're going to raise the price. And how will that impact churn? People canceling, people willing to sign up for Netflix? It probably will impact it negatively, but we will see very profitable United States and Canada streaming at Netflix. Now, EMEA, which is Europe, Middle East, and Africa, again, not a lot of net paid additions. Here we go, 0.19 went from 68.51 to 68.7. So we're basically flat there. So are the growth rates over there as well? And then we've got Latin America here. We're seeing, a steady growth, but again, we're starting to flatten out here as well. The big growth is in Asia Pacific. We're seeing a slight growth still in that low $1 million range in terms of net paid ads. And what we also see in the other countries outside of North America is a lower average revenue per membership as well. So they've got some room to grow still internationally, and they've got room to probably bump up prices just a little bit in those markets as well. Now, the last thing I want to do is take a look at the financials, and then we'll jump over to the stock chart. We'll see where this is at. We'll see if it's in a range where we could potentially buy this one, or maybe even sell this one if you already own some shares of Netflix. So we've got our 3 months ended here. Left-hand column is June, and it's year over year, and we're straddling the previous quarter here in the middle. So we've got our revenues came in at $7.3 billion. You see it's up quite a bit over the previous year, but basically flat or just marginally up over the previous quarter as well. You've got our 6 months ended here in the two right-hand columns as well. They're spending a little bit more on marketing. Okay, you notice last year we spent $434 million, then we spent $512. They bolted on almost $90 million on their marketing budget. Okay, so they're going to have to maybe potentially spend more to get less out of that marketing spend. Technology and development, basically flat quarter over quarter, but up over year. And you got some general administrative expenses. Those have ticked up marginally. So we've got our operating income coming in at $1.8 billion. That's actually down quarter over quarter. We've got some interest expense and some other income here as well. That gets us down to our quote unquote bottom line net income, $1.35 billion. That is down over last quarter where we're sitting at 1.7, but it's nearly double where we were back in June of last year. So they've done a nice job. Netflix has done a nice job kind of accelerating their growth during the virus, and they've done a nice job maintaining that subscriber base and squeezing a little bit more money out of them and keeping cost to a certain degree in check. We've got our cash and cash equivalents. The right-hand column is the end of last year, or really the beginning of 2021, and we've got about 6 months into it. We've seen we burned through a little bit of cash here, may have gone out to other current assets as well. That has ticked up a little bit, all things being considered relatively the same here on total current assets. You've got content assets ticked up. That's what you want to see with a company like this, because that is their moat around their business. That gives us a competitive advantage against maybe like a YouTube or a Disney Plus, those types of things, or allows them to remain competitive against those types of companies as well. Now, total liabilities coming in at $27 billion. We do have some long-term debt on this one. Doesn't surprise me. And in fact, it wouldn't surprise me if Netflix decides to leverage their balance sheet a little bit more. That's because they have to pay up to make shows. They have to buy the rights to series like maybe The Office or some HBO series or something or some movies that they want to add to Netflix. They got to pay up for those things kind of up front to a certain degree and then kind of monetize that asset over a period of time. That does take a little bit of long-term debt, but we see it actually ticked down over the last year or so. Some of it actually ticked over into the short-term side. Now, in terms of cash flows, we see evidence of their content assets here. So we've got this net income. We pull that down. We have that $1.35 billion worth of net income. We were sitting at $1.7 billion in the previous quarter. Now we get to add back in some things like this amortization of content assets. It's just weird how accounting rules work. Netflix has to account for any kind of content spend that they do. They have to expenditure it right away. So if they produce a movie or if they buy some series that they had to pay millions and millions of dollars for, they have to amortize that right away. But in terms of Netflix business, they see that they make money on that content over a period of time. So here's kind of an amortization of that. They actually get to add back in $2.8 billion. We see over the last couple of months and over the last year, it's been relatively steady. Now, we come all the way down to net cash provided by operating activities. We actually see it. We turn negative. We had actually negative cash flow over at Netflix at negative $63 million. We were positive 777. Go to Vegas on that one. You were positive $777 million and you were positive $1 billion worth of positive cash flow this time last year. So we have slipped into the negative in those types of things. Looks like we had some accrued expenses and other liabilities that might have played a factor in this. I don't think investors are too concerned about that. Now, we did repurchase some common stock in the quarter as well, about $500 million worth. Now, we did issue about $19 million worth of shares. All things being considered, they retired some shares over at Netflix, and that might have helped their EPS a little bit. Imagine if they did not buy back those shares, their EPS would have missed probably even more. Now, we talked about, so Netflix has been in sideways consolidation since literally this time last year. For over a year, this stock has been consolidating between $480 and we'll call it $560 per share. Has it peaked up above it a little bit? Has it peaked down below it a little bit? Yeah, but the bulk of the price action has been between that range of 480 to 560. I mean, it's actually a pretty tight range. And nothing has changed, quite frankly. A couple weeks ago, when we were doing our Friday stock show on the FANG stocks, we talked about how anytime you get down here into the 480s to 500s with Netflix, my opinion, this can be a buying opportunity because this is where the stock has bounced over the last year. It constantly has bounced between 480 and 500, and it walks its way like clockwork up to about $550, $560 per share and always sells off. And that's kind of what we're seeing here now. Now we're kind of smack dab in the middle of the range now, sitting around $524 per share. The stock reacted very negatively initially to the news, but has bounced back a little bit. Honestly, from a technical perspective, there is not much more to add here. This stock bottoms down here at 480. It tops out at 560. I wouldn't necessarily be running out and buying it at these levels, although if it does hold this 524 level, it doesn't really mean a whole lot. We're looking for a break above 580 on 560 on pretty big volume. Okay, you're actually looking for a break above 580. That would get you above this cluster of highs, and then you could be off to the races. You'd say a new trend is intact. Here, you're looking for a touchdown here at 480. If you break 480, there is some price action here. I wouldn't expect this one to really nosedive, but if it does, you might have some opportunities down here. But until further notice, Netflix is sideways consolidating. I think a lot of it has to do with the fact that they pulled forward a ton of gains in terms of subscriber growth over the last year, and that has completely stalled out and flattened out, and investors are waiting on their next move. And in my opinion, if it's video games, they're going to have to wait a little while, okay? You have Microsoft, you have Nintendo, you have Sony as the behemoths in the video game business, but you also have players like Apple and even Google and some other ones out there that play a little bit in that space as well. Netflix would likely have to wait a while to build that business up any significant direction. So I wouldn't necessarily want to run out and get Netflix shares unless, again, we break above this range and you play kind of a momentum play, or we start breaking down here closer to 580 and you get it on a value dip there. So that was Netflix, the first of the FANG stocks to report. Stay tuned to the channel for more. We'll be back again soon. Good luck with your investments.